Little short one right at the end. So we talked about interest rates on the one hand, we talked about QE on the other, and as is my way, I'm now going to find another hand from somewhere. In other words, there are other things that the central bank can do, and I think that's the key. It's getting all sunny, isn't it? So obviously they've got that, But what the central bank was saying just recently, so I'm making this in April, and we're talking about what their response to the kind of COVID-19 thing. What they were saying was that, well, look, we injected more money into the economy, and we cut interest rates to near zero levels. But what they were saying is, well, look, actually, what we know is that for banks, deposit interest rates are very, very low. So deposit interest rates are what they pay to savers. And these are already basically zero. And then there's their loan interest rates, which is what they charge to borrowers. Now, it's not quite as simple as this, but loosely, what banks do is they take the money that savers have deposited and they lend it to customers who want to borrow. And if I'm paying 0.5% to you there, and I'm charging 2.5% on a loan, on a mortgage, then my profit is 2%. So every pound I lend, I'm making 2% profit. Because I'm paying my customers, savers, 0.5%. I'm charging my other customers, my borrowers, 2.5%, and I'm the middleman. I make the profit. Well, the central bank was saying, look, actually, we know you can't cut these interest rates. We know you can't cut these interest rates any lower. Because otherwise people start taking their money out of the bank. And then you'll be screwed. So what they've said is, and so therefore you might not. And if you can't cut those, you therefore won't cut those because otherwise, you're not going to make any profit. So what they've said they're going to do is that they will make money available at this 0.1% rate. So this term lending scheme, they'll make a certain amount of money available basically at 0.1%, for banks and building societies that are prepared to lend directly to SMEs, small and medium-sized enterprises, because they're the ones who end up in the biggest difficulties during the financial crisis. They're the ones that really get hit for credit. They haven't got much alternatives. They haven't got collateral. They haven't got big reserves of cash that they can survive with. So what they said is, if you as banks, are prepared to lend to these people, then we'll make you a pool of money available, which was quite a lot, 100 billion. We'll make up to 100 billion pounds available, for you to lend directly to small and medium-sized enterprises at low interest rates, because we are prepared to lend it to you at low interest rates ourselves. So banks can borrow directly from the Bank of England to lend money to small and medium-sized enterprises. And so in other words, it's not just QE, it's not just making interest rates low, they're directly controlling the banking system. And they can directly control the banking system in other ways by talking about how much cash banks have to hold and so on. So we talked about this before, this idea of cash ratios or liquidity ratios and so on. But in other words, there are alternative forms of monetary policy. And as the Bank of England announces these things, you need to be we'll tell you about them, but you need to be vaguely aware that it's not just interest rates and QE. Sometimes the central bank will come up with other measures, that it can use then to stimulate economic activity, or sometimes to restrict economic activity. So in principle, we could demand that banks hold more cash and stop lending. So that's just the final section. So it's just a quick short one, and that should be it for monetary policy. Next one will be exchange rates, but I'll do that in a separate section.